Hello, and welcome to Chapter 5. This is the last chapter before your midterm exam. Before I start, I'd like to remind you to log into SFU Canvas and download the blank notes so that you may follow along. Chapter 5 focuses in on the merchandising cycle. So we're going to have examples of businesses buying items and selling them to their customers at hopefully a higher price. So that brings us to our first definition for today. Inventory. All goods owned, either made or purchased by a business, which can be sold to customers to generate revenue. Merchandising. Buying and selling products as opposed to performing services. Some common items found in the financial statements of merchandising firms are, and you're going to see these come up over and over again in this course, and probably any future accounting courses you take. On the balance sheet, we will have inventory in the assets section. So inventory is something that we hold amongst our other assets, which is likely going to help us make money in the future. So it's classified as an asset for the business. On the income statement, we will have several items relating to inventory specifically. One is sales revenue, which comes from selling inventory. Sales revenue is the amount that you get from your customer. And then you also have cost of goods sold expense. This is how much the inventory had cost you prior to selling it. For example, if you have inventory that you sell for $10 and it had cost you $7, the sales revenue will be 10 and COGS will be 7. The gross margin is the difference between sales revenue and cost of goods sold. So hopefully, if you're buying your product for less and selling them for more, your gross margin is positive. So sales revenue, the selling price of merchandise sold by a business. Sales revenue is often abbreviated as just sales. This is how we kind of get to sales. We have net sales equals sales revenue, which is the aggregate sum of everything that we've sold, minus sales returns, and minus sales discount. So typically the way this process works is we only credit sales revenue. We never debit it. Whenever we have a sales return or we offer sales discount, we have contra accounts, which take on those amounts, and at the end of the reporting period, we figure out what net sales is by taking our big number and subtracting off two smaller numbers, which are returns and discounts. Cost of goods sold or cost of sales. The major expense of a merchandiser, which represents the entity's cost of inventory, which were sold to customers. So as I mentioned, hopefully this is lower than your sales revenue. So you have a positive gross margin. As you can see here, your gross margin comes from taking net sales, which is calculated by the formula above, and subtracting off cost of goods sold. So we're going to go ahead and try an example. The SFU bookstore has a one-day spring clearance sale where all books are 10% off if paid for within 1 week. All purchases were paid for within the discount period. If 50 books sell, the regular price is $100 each, with only 5 returns. What are the net sales? So this is a pretty straightforward question as I've given you the calculations. but just take a minute to try it and we'll resume in the same video. So we have 50 books that we've sold at a price of $100 each. So that's 50 books times $100 give you 5,000. And we had 5 returns. So 5 books were returned at $100 each. And then we offered the sales discount. So this is a little bit interesting, so I'll pause here. The 45 number comes from the 50, which we originally sold, less the 5. So we only have 45 books out there which students have bought from us. And since all of them pay early, all 45 books get that 10% discount. So if each book is $100, 10% of $100 works out to $10 per book. So take the 45 books that are out there, multiply by a discount rate of $10 per book, and then we will get 450. Now it's a matter of doing simple math. We have sales revenue of 5,000. We have sales returns, which we're going to take off sales revenue of 500, and we also have sales discount we will subtract off of 450, and then we will get our net sales number of 4,050. That's how that's done. Sales revenue minus sales return minus sales discount give you net sales. Pretty straightforward process. So moving on to the next part over here. If each book costs the bookstore $55, and we will show you a breakdown on the following page, what is the gross margin? So maybe take another minute to do that, and we will go over the solution here in the same video. So first and foremost, we have our net sales. This net number is coming straight from above, straight down. 4,050 are net sales, and we're going to subtract off a cost of goods sold. So I've given you number of books here and the cost per book. So we're just going 45 books times $55 per book, and we will get 2,475. And we subtract off sales revenue minus cost of goods sold, and we will get a gross margin, which is thankfully positive, of 1575. So as promised, we will be looking at what goes into inventory cost and specifically these books, which the bookstore is selling. The cost of inventory on a merchandise's balance sheet represents all the costs incurred to bring the merchandise to the point of sale. As an example, let's consider a textbook in the SFU bookstore's inventory. The textbook cost listed on the balance sheet as inventory include, first and foremost, the most obvious one, the cost of the textbook of $40. The money that the bookstore pays to its supplier is the primary portion of its cost. And then we have customs paid to the Canadian government to import the good. That's $5. Customs or taxes are another cost which add to inventory. And then we have to pay for shipping, $7.50. The cost is called freight or freight in. We have insurance cost. So when we ship something, we don't want it to go missing, so we pay for insurance. $2.50. The cost of insuring a shipment should also be included as part of the goods costs. The cost of any asset is the sum of all costs incurred to bring the asset to its intended use. So as this bolded sentence implies, this list that we just covered of 4 items is certainly not comprehensive. In fact, there can be a lot more costs which are incurred along the way to bring a product to its selling point. There might be storage, there might be insurance while the product is in storage. So anything like that you can add to the cost of the good. And when you sell it, it becomes cost of goods sold expense. Moving on to a new topic here called periodic inventory system. This system is based on an inventory count at a specific point in time, and it's often period end. And this is an alternative to maintaining updated records at all times. So this is in many ways an outdated inventory management system with better technology out there and stronger accounting knowledge. So with computers, we can take advantage of easier ways to consistently keep track of what we hold inside our business. Going back to periodic inventory system, once we conduct a physical count, what remains in inventory at the end of the period, we have the cost or value of ending inventory. Then we can calculate the cost of inventory sold, which is cost of goods sold expense during the quarter or any reporting period for that matter. So we're going to start up here. If we take what we had at the beginning of the period, on the beginning inventory, and we add on the cost of the goods purchased, what we get is the total goods available for sale. There's the maximum we can possibly sell to our customers. In other words, we cannot sell what we don't have. And if we take the maximum that we can possibly sell and subtract off what we have left at the end, known as ending inventory, we get cost of goods sold expense. So this is typically how merchandising works. You very rarely will get a store that sells absolutely everything that it has purchased or acquired. And the reason for that is simply you don't want customers to come into your store looking for a certain good and leaving disappointed because you don't have a good in stock. There's always a little bit of a safety net which serves as beginning inventory for the following period. So if we were to take away this intermediary step, goods available for sale, we can get a more succinct formula. We have cost of goods sold equals beginning inventory plus the cost of goods added minus ending inventory. So this formula here gives you your cost of goods sold for the period. This next exercise here is going to bring that formula we just saw to life. So here we go. Let's try an example using the SFU bookstore. In quarter 2, 2021, the bookstore produced sales revenue of $1,950, less sale returns of 100, and sales discounts of 200. And all amounts are in thousands of dollars. So this exercise involves starting with numbers from Q1 and doing a similar process with Q2. And you also have some information at the top, don't forget. So let's have a go at this exercise and we will go over it in the next video.